This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. We will continue from session 1, already in progress. John, will you add what you think the consequences are going to be of this Fed decision?
Yeah, there are a lot of consequences, and some of them are kind of contradictory. So it's really hard to tell what all this means. But for one thing, with the economy decelerating and interest rates already rising, the Fed really can't end QE. So we've kind of baked in the cake an extended period of extreme money creation.
This is what I refer to as global Abenomics.
Yeah, exactly. We just can't get away from this because the minute we try, so much of the positives in the mind of the central bank of this policy reverse right back out. The markets just spike interest rates.
We're over the event horizon now.
Yeah.
I think this will go down in history as the cusp. By reversing on the taper, and it won't be implemented, this is when we went over the point where we had to accelerate. We lost control because effectively we lost control of the bond market when we started talking about taper back in May and June. And I think that scared and frightened the Fed, and they realized they had stayed too long at this party.
Mm-hmm. And this is really an amazing thing that we as a system can't seem to handle interest rates that just go from incredibly low to very low. Not even back to historically normal, but a 4.5% or 5% mortgage rate. I have a friend who's a real estate appraiser, and he said refi activity has cratered. You know, it's just totally shriveled up because nobody's refinancing their mortgages at 4.5%. And for the banking industry, that's where the real money is. You know, mortgages that are taken out for home sales are a much smaller part of the business for a bank than refinancing.
But the people in real estate are telling me it isn't the absolute 4.5%. It was the amount of the change and the speed of the change. And it has completely collapsed any of the refi, any of the mortgages. Mm-hmm. Just it's absolutely stopped it in its tracks.
Yeah. And so you see these big banks laying off people in their mortgage departments now. And,
precisely.
And so when bad things happen at big banks, that gets the Fed's attention because they're basically the employers of the government right now. You know, so that's like your boss having some kind of a problem. You know, you need to pay attention to that because they're in charge. And so when the big banks have to start laying people off, that's an early sign of a policy change. and it worked this time. You know, they pulled back from the intimation of a policy change that had caused the trouble for the big banks. And we already talked about the emerging markets. We're going to see hot money flowing back into them and destabilizing them. And the dollar will be weaker, other things being equal, if we keep this up. And you would think this would be phenomenally good for precious metals. It's not today. You know, the stock market is down. By the way, one of the Fed governors came out and was talking about, as you said, renewing the idea of tapering in later months, and that the stock market is cratering, precious metals are down. So we're seeing the markets react instantly to even talk about this stuff. But when they take it back again, as they will have to, it should be very good for precious metals. And it's questionable what it means for the stock market because technically the stock market is ready for a massive correction. You know, you've got every kind of technical indicator you can think of right now pointing towards a 30% drop. You get the head and shoulders pattern forming over the last year, and margin debt is through the roof, and lots of other indicators that people use for technical trading are pointing down. And yet you've got all this new money coming in and it has to go somewhere. So maybe the stock market will have new life. You can't know which way that's going to go, I don't think. And then bonds are another big question mark because in the short run, the government buying lots of bonds is good for bond prices and generally forces bond yields down. But to the extent that all this extra money causes instability in the financial markets, that's bad for bonds. Who wants to lend money to a government for 30 years at 4% when that government is creating new currency equal to like 8 or 10% of GDP every year, with no end in sight? So what we're doing is creating the conditions for extreme instability by continuing quantitative easing. And at some point, it becomes really hard to predict the nature of the instability because there are so many cross currents. Stocks could spike or stocks could collapse. And either one is a completely logical outcome of what we're doing. And the same thing with bonds. We could see bond prices be forced back down again, or bond yields be forced back down again by what they're doing. Or we could see the bond market just give up on this whole thing and spike yields, no matter what the Fed is doing. And so I think it's almost to the point where we basically just want to buy volatility and bet on instability and chaos and not worry about individual asset classes anymore. So that was a good play in 2008, and it may be a good play again here in the near future.
I did a session with Axel Merk, and he's probably one of the best in the world in currencies, and certainly manages enough money in trading currencies. And he says very similar thing to what you just said, John, that in looking at asset classes and trying to remove the equity risk and the interest rates is why you want to be, in his case, he believes in currencies, but that we're going into a state of accelerating chaos, uncertainty, social unrest that he believes is going to create a serious flight to perceived safety. So when you're talking about, whether the market's going to go up or down, it's exactly right. In actual fact, I believe it's going to do both, John. And how's that going to be? I have a chart here that I put together in a series I did with Ty Andros on the crack-up boom. And you can see up there in the top in the red is where we kind of believe we are. And this is going back to August 1971. And during this final little push-up is really during this chaos and this uncertainty. And it's going to happen because, we were mentioning emerging markets. They're faced with a decision right now as they have risk back on and hot money flowing back in and driving their currencies up as though we're going to be back into a currency war. They're basically having to make a decision. Either it's capital controls or let the Fed run my economy. And they're so angry and so upset. And you've heard them, places like Brazil vehemently out in the press. And now they're facing social consequences of the inflation pressures that are pushing into these countries. They have all facing significant elections that are coming, that are spaced out, which are going to be very, very disruptive. So the bottom line from that is, though the money temporarily is flowing into these economies, a lot of the risk will be taken off, and the money will then flow to some perceived safety, and it'll flow down in the red towards as the ladder is lifted from the bottom. I'm showing the U.S. here at the bottom part of that red, but it'll get it as the stock market we believe will continue to lift for reasons that it shouldn't, because earnings are plummeting. We're going into a recession, which are all bad things for the economy, but they're bad things globally. And this is the first time we're going to see a global recession. So the money's going to be withdrawn and pulled because it's so highly leveraged in where it'll go. And it'll go to safety, and right now that's perceived to be the U.S. dollar, U.S. investments, and therefore it'll be the last one kind of fall. But that's short-lived because we're in the final run. And so we see a little bit more artificial lift, if you would, maybe a near-term correction, but an artificial lift. And then all of a sudden we have the beginnings of a financial collapse in nominal terms. It's not just real terms, as we take out the malinvestment and the mispricing. But we're not there yet. And John, it reminds me not just of 1987 and the crisis that we had then, but it also reminds me of the fall of 1999. In both cases, the markets just kept coming. They disconnected from reality. We couldn't figure out what was. We are all anticipating a 20% correction, but John, in both cases, it didn't come for months and months after. And then finally, we'd all kind of thrown in our towel and said it's different this time, and then it hit. And it hit with a vengeance, and it was of historic proportion. But it was months and months after even the most negative bears had finally thrown in the towel. And I see that the same thing happening if, in fact, we see this crack-up boom.
Yeah, that is the really frustrating thing about bubbles. They keep on going so much longer than they should, really. Because I shorted tech stocks in 1998, and I shorted the housing stocks in 2006. And so in both cases, there was an agonizing year or more to wait before things finally worked out. And this is kind of the same thing, because no way we should be here now. There's no way that a country like the U.S. that has doubled its government debt in the past 3 years and that is pumping out $10 trillion of new currency into the market, that should be the safe haven for the world. And yet, you're right. This is the least ugly situation out there. And so capital is very possibly going to flow back here for a while. And that's just astounding. If you looked at the U.S. in a vacuum, just looked at its numbers, you would say this is the world's problem area. But
you go into places like Argentina, Buenos Aires right now, and the street people will pull you at any corner. They're trading their currency for U.S. dollars. Okay,
yes.
And I say that as bad as our problems are, they're worse around the world. And therefore, the perception is reality. And the perception is the United States is still the safest place. And that is because we still have 60% plus of the reserves around the world are trading in U.S. dollars. That's just the nature of the momentum. And we have the biggest military in the world. So there's a perception that it's the safest of a bad crowd. And so that's why it'll go against all logic in my mind and flowing back towards some kind of protected assets in the United States, because it's still believed that it's governed by laws and your assets won't be seized. But it's only a matter of time, John. That'll be short-lived. In my mind, sometime in second half of 2014, we're out of runway.
Yeah, because so much could happen. I mean, you can think of 10 different things that would completely change the calculus in the U.S. And I think one of the really interesting ones is China announcing that they actually have 6,000 tons of gold instead of 1,000 tons, and they're going to henceforth back their currency with gold.
And there will be a day where that's coming.
Mm-hmm.
And they're preparing for it. There's no question they're preparing for it. They don't want to do it. But I believe they will be forced to do it out of self-survival. As you see them doing already this week, announcing they're going to major shift in their economy where they're going to look for internal growth versus export growth, and that is they want it to be consumer-led. That's a big change in talk. I've never heard them talking that way before.
No, but it has to happen eventually. And so it's just a question of when they feel forced into it, or when they feel so confident that they might as well do it because there's no downside.
I think it's the former.
Yeah.
I think they've realized they have no choice now because there is no global growth. Global growth has been falling steadily. That is the single issue. Every corporation on a global basis will tell you they can't find growth rate. Growth is not fast enough, and it's not fast enough in relationship to inflation and the interest rate on the debt they've financed. It's eating them alive. And their EBITDAs are falling off. Therefore, there's no wealth creation. When there's no wealth creation, when you have debt saturation, you implode because it has to be withdrawn in a fractional reserve basis system. That's what's happening. And you can buy time, and that's what we bought. We bought 5 years. I think we can probably buy another 10 months. I don't know what the number is. There's more time we can do because there's more bullets that we can fire. Globalized central bank emergency actions are still in front of us. So that'll buy us more time in this flight to perceive safety. But we are out of runway, John. This plane is not going to lift off.
Yeah. The next few years can't be anything but chaotic.
But it has to be, because what we need to do is get rid of the malinvestment and the mispricing, because in the capitalist cycle, The only way you get investment to come back in is because there's a decent return, and risk is incorrectly and totally mispriced in the world. These are the moral hazard, unintended consequences that come from monetary malpractice that we've had for such as a sustained period of time. If we would just allow the capitalist system to work, but we can't, because the beginnings of any bankruptcy, we're so over leveraged, and there's a rehypothecation with debt having been turned into an asset, will just crush the system, because we've never had such a major downturn since we brought in securitization, which converted debt to assets. And the closest we got was 2007. And the future could look like a minor correction or a warning.
Yeah, and this thing with tapering is the perfect example of what they face when they try to bring a little rationality back into economic policy, because the markets freak out. Yeah.
A miserable $10 billion reduction on $80 billion a month, and this is the problems that it caused?
Yeah. And that really wouldn't have made any difference in terms of the volume of money that we're pumping out. You know, we still would be pumping out way too many dollars for any rational economic policy. And yet, even that tiny little change caused the bond markets to freak out, caused the emerging markets to go into a tailspin. And it illustrated why the Fed can never get out of this box. So we're basically on this course now. You know, it's baked in the cake. We are going to head this direction until we can't go this way anymore. So it's really a matter of timing now. When does the market finally put a stop to this?
And it's very close. And I say that because remember why they started talking about tapering. It's because the TBAC was warning, which is the advisory to the treasuries and the FOMC, that the availability of riskless collateral, that is bonds, was disappearing and drying up. So therefore, refunding was not working, repos were not working, and they couldn't get the credit flowing. And that's because the Fed is over 1/3 of the bond market, and it's only increasing. So it's literally seizing all of the assets that are debt instruments that are used for collateral. And they said, you've got to stop this. You've got to be less of a percentage. And that's why they started talking taper. Now they're going to go back. They're going to leave it on. So the problem's only going to get worse at 80 billion a month. So that's why I say the runway is ticking. And they were screaming, John. I mean, they just weren't warning. They were screaming at the seriousness of the problem. So you can tell you the other flip of it for them to reverse it. This is called the Bernanke box, and we're in it. And that's why it's time for him to leave, and whoever comes in will have the opportunity to do far-reaching new experiments in monetary policy. And trust me, they're coming.
You should put together a future show on different ways to bet on volatility, since we're clearly heading into a time when there are going to be spikes and crashes as the system, begins to really spin out of control. A lot of money will be made by doing things like volatility spreads and trading in and out of those volatility ETFs and things like that. So I know you're not an investment advisor, but I think that people would find that fascinating. So just an idea for a future show. Yeah.
We are through traders, and I can tell you right now the game is in volatility, but you got to be very careful, because VIX is a measurement of the options pricing, and options are all what you're trying to hedge with the derivatives. And through to the swaps marketplace. So even using VIX as a measure is a funny game. It's an orchestrated game, if you would, because of what's going on behind the scenes. But volatility per se is absolutely where you want to be investing, but choose your instrument very carefully. It isn't what it might appear on the surface.
Oh, absolutely. Yeah.
We're way past our hard line. A great discussion here. Any closing comments you'd like to make?
No, Gord, we have covered a lot of this territory. So, but you're right. We can't do this in 20 minutes, can we? It takes an hour to get through all the stuff that you and I just want to talk about when we meet.
Well, that's why we do these once a month, and every month there's too much to talk about. So, John, could you tell our listeners, for those that may not be fully aware, how they could read more of your work and your site?
Yeah, I run dollarcollapse.com, which is a news aggregation site / blog that covers a lot of this stuff, updated daily. Well,
I'm looking forward to next month. I have no idea what we'll be talking about then, but I'm sure it'll be just as interesting. Talk to you then.
Thanks. See you, Gordon.
Thank you, John.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.